That's scenario 6. You sold John and Hillary their home 1 year ago. John is a partner in a litigation law firm while Hillary is the chief accountant of a public agency. They have inherited a portfolio of commercial investment properties that is worth $30 million scattered around the Lower Mainland in the past 2 years. Today, you receive a call from Hillary asking if you want to meet her and John to talk about listing one of their apartment buildings in the Metrotown area. Before the meeting, Hillary sends you the statement of loss and deficit from last year. So here we have a statement of loss and deficit for the year ended December 31st, 2015. Revenue, rental income. In 2015, that was $414,670, and that is also the total revenue. We go down to the expenses. Let me see if I can increase this here so you can see it better. So we have the bank charges and interest, $1,023. We have the business license, $1,449. Depreciation is $127,833. Insurance, $10,945. Legal and accounting, $2,509. Loan interest, $158,624. Management fee, $8,763. Miscellaneous, $903. Office supplies, $0. Property taxes, $26,238. Repairs and maintenance, $44,260. We have the salaries and benefits, $26,441. Telephone, $919. Utilities, $70,813. Waste removal, $7,264. WCB expenses, $253. And we have the total expenses, comes out to $488,237. Now we gotta decrease this a bit. So 6-1, based on the information in the statement of loss and deficit, fill in the necessary fields on the annual property operating data APOD below for the property Appendix L, page 101. So this is kind of like homework. So if you take a look at this sheet here, we've got the annual property operating data. So that's what we call it, APOD. Property name, plug it in. Location, type of property, size of property, square feet, and also units. Purpose of analysis. Then we go down here to the assessed appraised values of the land. Over here, improvements, Class 1, Class 8, and Class 17, all improvements, and then the total. And adjust this basis as of, and put that here. On the right-hand column, it says purchase price, plus acquisition costs, plus loan fees, less mortgages, and then equals the initial investment. So here we have a balance for first and second. All these have a first and second line, horizontal line. So we have the balance for first and second, the periodic payment, the payments per year, the interest, the amortization period, and the loan term. So take a look at this. All figures are annual. So we have number 1, potential rental income. All right, the dollars per square foot or dollars per unit, and then we have the percentage of the GOI. We have comments and footnotes section. So 2 here we have plus the other income affected by vacancy. 3, less vacancy and CR losses. That's credit? Okay. All right. Then we have 4, the effective rental income. 5, plus other income not affected by vacancy. 6, gross operating income, operating expenses. 7, we've got the real estate taxes. 8, bank charges and interest. 9. Property insurance. 10. Off-site management. 11. Payroll. 12. Expenses and benefits. 13. Taxes, workers' compensation. 14. We have repairs and maintenance, utilities. 15. We have management fee. 16. Telephone. 17. Waste removal. 18 is blank. 19. Accounting and legal. 20. Permits, licenses and permits. 21. Advertising. 22. Supplies. 23. Miscellaneous contract services from lines 23 to 28. Then we have the total operating expenses. 29. 30 is net operating income. 31. Less annual debt service. 32. Less funded resources. 33. Less leasing commissions. 34. Less capital additions. And 35. Cash flow before taxes. And this is, it says here, authorized by Gary G. Thorpe, CCIM, copyright 2001 by CCIM Institute. So this is the Training Institute. The statements and figures herein, while not guaranteed, are secured from sources we believe authoritative, prepared by, put the name, prepared for, put the name. So, 6-2, what is the operating expense of the property? 6-3, what is the net operating income of the property, assuming you have 0% vacancy and bad debt? Capitalization rate, cap rate. This figure measures the income generating performance of a property related to the purchase price. It is expressed as a number, for example, 8 times. It basically measures the payback period of the net operating income against the purchase price. So take a look over here. It says a cap rate equals the NOI, the net operating income, over the purchase price. So R is rate, that is the cap rate. I is the income, for example, that is the net operating income, and V is the value, the purchase price, here in this diagram. So we have the rate is equal to the income over the value, and this is the value equals the income over the rate, the cap rate, and then we have income here equals the value times the rate. Turning the formula around, we can calculate the purchase price, market price from cap rate as purchase price slash market price equals the net operating income, NOI, over the cap rate. Turning the formula further around, we can calculate the NOI from cap rate. Net operating income, NOI, is equal to the purchase price over the market price times the cap rate. So 6-4, based on the information of the property in scenario 6, what is the cap rate of the property if the market price is $7,280,000? 6-5, based on the information of the property in scenario 6, what is the market price of the property when cap rate is 3.3%? 6-6, if the buyer thinks that he or she can reduce the operating expense by 10%, what is the market price of the property when cap rate remains at 3.3%? 6-7, what is the market price of the property when comparable cap rate drops 10% itself to 3.0% and everything remains the same? So the cap rate value of $1 change in NOI. Take a look here. Cap rate 2%. The value is $50. The cap rate is 3%. The value is $33.33. $33.33. 4% is $25. 5%, $20. 6%, $16.67. 7% is $14.29. 8% is $12.50. 9% is $11, and 10% is $10. Case study. 1. Seller representative. You sold John and Hillary their home a year ago. John is partner in a litigation law firm, while Hillary is the chief accountant of a public agency. They have inherited a portfolio of commercial investment properties that is worth $30 million scattered all around the Lower Mainland in the past 2 years. Today, you receive a call from Hillary asking if you want to meet her and John to talk about listing one of their apartment buildings in the Metrotown area. They want to put the property on the open market and offer to pay a total commission of 4%. They provide you with the current balance sheet and statement of loss and deficit of the property. They have a listing price of $7,280,000 in mind. The building has a pet restriction policy and no pets have been allowed since day one. So you have a statement of loss and deficit here for the year ended December 31st, 2015. So we have the rental income, $414,670. Total revenue is the same. Expenses, let me enlarge this here. So we've got bank charges and interest, $1,023. Business license, $1,449. Depreciation, $127,833. Insurance, $10,945. Legal and accounting, $2,509. Loan interest, $158,624. Management fee, $8,763. Miscellaneous, $903. Office supply, $0. Property taxes, $26,238. Repairs and maintenance, $44,260. Salaries and benefits, $26,441. Telephone, $919. Utilities, $70,813. Waste removal, $7,264. And WCB expenses, $253. Total expenses, $488,237. So we have another balance sheet here as of December the 31st, 2015. So the assets, we have a current assets cash, $128,637. Prepaid expenses and deposits, $17,315. which all equals $145,952. So that's what we get when we add 128,000 plus when 17,000 plus for the current assets, cash, prepaid expenses, and deposit. Then we got a property, and there's a note 1 there. We'll look at it. Should we look at it now? Note 1? Can't find it. All right, so note 1. It says land is worth $2,249,122. The building is $3,685,231. You add those two numbers together, you get $5,934,353. So you minus or you less the accumulated amortization and depreciation, which is $617,251. And that comes out to a total of, because we're minusing that from 5.9 million plus, so that comes out to $5,317,102. So other assets, we have an incorporation cost, $1,288. Total assets, $5,464,342. So liabilities, share capital and deficit. We have current liabilities, accounts payable, $288,678. We've got the payroll remittance payable, $443. Deposits received, $15,824. You add all these current liabilities together, you will get $304,945. Long-term liabilities due to shareholders, note 2, $633,982. And loan payable, note 3, we've got 5,665,582. Sorry, I'm getting this wrong here. The due to shareholders is 3.6 plus million. The loan is about 2 million. So you add those up. Yeah, sorry, the loan payable is 2,381,600. 2,031,600. You add those up, it comes out to 5.6 million plus, right? 5,665,582. So we go to the share capital and deficit. Issued and fully paid 2,000 common shares at a penny each. So that's 20. And the deficit is 506,215. So that is equal to 506 or minus 506. And that deficit was like a minus, okay? So anyways, we got minus 506,185. So we've got the total liability, share capital and deficit here. It's 5,464,342.